The pen is already in your hand. The notary has stopped talking. Everyone in the room is looking at you. The lawyer, the buyer's agent, your own reflection in the glass partition behind them. You sign. 3 signatures, 2 initials, and it is done. Years of mortgage payments, bad tenants, 2 a.m. repair calls, and 1 renovation that nearly bankrupted you. All of it collapses into a single wire transfer number sitting on the page in front of you. Tax-free, protected, gone into your account before the week is out. You exhale for the first time in months. 6 weeks later, a registered letter arrives. You almost miss it because it looks like junk mail until you see the Canada Revenue Agency letterhead in the corner. Your hand slows down, you open it. Inside is a notice of audit, not a general inquiry, a targeted, document-specific audit of the exact sale you just completed. The exemption you claimed. The gain you declared tax-free. CRA is not asking questions. CRA is asking for proof. And here is where most Canadians discover, far too late, that the principal residence exemption is not a right. It is a claim, and claims can be denied. Welcome back to Canada Property Watch. In our previous investigations, we exposed how the CRA's Form T113 5 data matching system has already flagged thousands of foreign property holders who failed to disclose offshore assets, and we broke down exactly how the self-supply rule under the Excise Tax Act has been silently vaporizing the equity of new construction investors across the country. Now, today, we are going inside the 3 specific categories of proof that the CRA now demands before they will accept your principal residence exemption claim. And we are going to show you exactly how the absence of any one of these 3 proof items triggers an automatic reassessment that can eradicate your tax-free status entirely and replace it with a taxable capital gain large enough to financially execute a family. Before we go further, quick question for the room. When you sold or planned to sell your home, did you keep all your renovation receipts? A for yes, B for no. Drop it in the comments. You will understand exactly why that question matters in about 90 seconds. Let us start with the foundational legal mechanics, because you need to understand what the CRA is actually doing when they review a principal residence exemption claim. Under the Income Tax Act, specifically subsection 54 and the related provisions in section 40, a taxpayer can designate a property as their principal residence for each calendar year they ordinarily inhabited it. The key phrase, ordinarily inhabited, is not defined with mathematical precision in the legislation. CRA has published administrative guidance, and the Tax Court of Canada has produced a body of case law around it. But the absence of a rigid statutory definition is not a loophole in the taxpayer's favor. It is a trapdoor, because it means the CRA retains enormous discretionary power to challenge your designation on the basis of the evidence you provide, or more precisely, the evidence you cannot provide. The agency has been systematically building its audit infrastructure for the better part of a decade. The data pipelines that now feed CRA's risk scoring systems pull from land registry records, hydro and utility billing addresses, school enrollment records, municipal permit databases, banking transaction histories, and even Canada Post mail forwarding records. When you file your T1 return and claim the principal residence exemption through Schedule 3 and the designated year election, that claim does not sit in a filing cabinet. It enters an algorithmic matching process. If your claim produces an anomaly against any of the external data sources CRA has access to, a review flag is generated. That flag can sit dormant for up to 3 years under the normal reassessment window, and up to 6 years if the CRA believes misrepresentation was involved. In cases of fraud or gross negligence, there is no limitation period at all. This is the environment inside which every Canadian homeowner now exists when they sell a property and claim the exemption. And within this environment, 3 categories of proof have emerged as the primary battlegrounds where exemption claims are either defended or destroyed. The first category is proof of physical occupation, genuine, continuous, documentable residency at the property during the years you are designating. This sounds self-evident. You live there. Of course you have proof, except the CRA's threshold for what constitutes acceptable proof of physical occupation has risen sharply. particularly for properties sold after 2016 when the mandatory reporting requirement for principal residence designations was introduced. Before 2016, taxpayers could sell a home and claim the exemption without even reporting the transaction on their tax return. That era is over. Since 2016, every disposition of a property must be reported on Schedule 3, with the designation years clearly declared. And since that reporting requirement was introduced, audit rates on these claims have climbed steadily. What CRA is looking for when they probe occupation is a coherent, internally consistent evidentiary record. They want utility bills, hydro, gas, water, all addressed to the property and showing consumption patterns consistent with a family actually living there. Not minimal baseline usage, but real residential consumption. A property with 8 months of near zero electricity consumption in a Canadian winter, while the owner claims to have been sleeping there every night, does not survive contact with a forensic auditor. They want banking records with transactions geographically centered around the neighborhood. Grocery stores, gas stations, pharmacies, restaurants within a reasonable radius of the property. They want the vehicle registration reflecting the property address. They want the provincial health card, the driver's license, the OHIP or MSP enrollment, all consistent with the claimed residence address and the claimed years of habitation. Here is where the executions begin. Investors who purchase properties under the stated intention of personal use, then rented them out, even informally, even for short periods, and then later claim the full exemption, are being caught because their own paper trail destroys them. The rental income they failed to report produces a discrepancy in their T1. The hydro bills showing high consumption during a period they claim to have been traveling on business contradict their occupation narrative. The tenant whose name CRA found in a municipal rental registry for the subject property, a registry the investor did not even know existed, has already supplied documentation that eradicates the occupation claim for the specific years in question. When occupation proof fails, the consequences are not proportional. CRA does not deny the exemption for the specific years where the evidence is thin. They reassess the entire designation period with compounded interest and potential gross negligence penalties applied to the full capital gain that has now become taxable income. On a property that appreciated by $600,000 over 8 years, the tax liability after penalties and interest can exceed $220,000. That is not a fine. That is a financial execution delivered by registered mail. The second category of proof that demolishes exemption claims is renovation and improvement documentation. Every single dollar spent on the property during the ownership period. This one is more nuanced and far more dangerous because the failure to document renovations does not just threaten the exemption. It can independently trigger a separate audit stream focused on the adjusted cost base of the property. Stay with me. This next part changes everything about how you think about renovation receipts. Under Canadian tax law, your adjusted cost base, the ACB, is the foundation upon which your capital gain is calculated. The ACB starts at your purchase price and increases with eligible capital expenditures, structural improvements, additions, major systems replacements. Routine maintenance and repairs do not qualify for ACB treatment, but improvements that extend the useful life of the property or materially enhance its value absolutely do. The problem is that when a homeowner cannot produce receipts because they paid a contractor in cash, because they threw the paperwork away, because they assumed the exemption would make all of it irrelevant, the CRA is legally permitted to deny the ACB adjustments entirely and calculate the capital gain using the original purchase price as the sole cost base. The mechanics of that denial are catastrophic on appreciated properties. Consider a homeowner who purchased a property in 2012 for $550,000 in the Greater Toronto area. Over 10 years, they spent approximately $180,000 on a basement addition, a kitchen overhaul, new HVAC, a garage extension, and exterior work. In 2022, they sold for $1.3 million. With proper ACB adjustments, the capital gain before the exemption would have been $570,000. Without any ACB documentation, every renovation denied, the capital gain balloons to $750,000. If the exemption itself is also challenged and partially denied, say for 3 years when the property was rented, the taxable portion of that gain can be $180,000 or more. At the combined marginal tax rate applicable to a taxpayer in Ontario, that produces a bill north of $80,000. And there is a second dimension to the renovation documentation problem that most Canadians are entirely unaware of. If the CRA's audit reveals that the renovations were done by unregistered contractors paid in cash, the auditor is required under agency protocol to escalate the file for potential referral to the Underground Economy Initiative. The homeowner is no longer just facing a tax reassessment. They are now inside a parallel investigation focused on whether they participated in unreported commercial transactions. That escalation can result in a separate penalty assessment on top of the original reassessment, and it can extend the reassessment period because the CRA now has grounds to allege misrepresentation. The practical lesson here is brutal in its simplicity. Every receipt, every invoice, every bank transfer, or canceled check related to any improvement made to any property you ever intend to sell must be retained permanently. Not for 3 years, not for 7 years, permanently. Because the CRA's review of a principal residence claim can reach back to the original purchase date, and the ACB documentation burden sits entirely with the taxpayer. In comment section, this one is useful data. Drop me plus the year you bought your home. We are tracking something specific, and the response from this audience is going to inform the next investigation. The third category of proof is the most devastating because it is the one that almost nobody anticipates, and it is the one that the CRA's algorithmic systems are now specifically designed to surface. It is proof of genuine intention, demonstrating that your primary purpose in purchasing and occupying the property was personal residential use, and not profit-motivated real estate speculation. This is where the legislative concept of the adventure or concern in the nature of trade enters the picture, and it is lethal. Section 9 of the Income Tax Act, along with the judicial doctrine developed through decades of tax court jurisprudence, NUMDI establishes that when a taxpayer's primary intention in purchasing a property was to profit from its resale, the gain on disposition is characterized not as a capital gain, which benefits from the principal residence exemption and the 50% inclusion rate, but as business income. Business income is included in taxable income at 100%. The principal residence exemption does not apply to business income dispositions. 0. The entire gain is taxable at the taxpayer's full marginal rate. The CRA does not need a confession to establish intention. They construct the case from objective indicators: the frequency of transactions, how many properties you have bought and sold in the past decade, the duration of ownership. Properties held for less than 24 months are automatically flagged in the risk scoring model. Your professional background. Are you a realtor, a mortgage broker, a general contractor, a property manager? If so, your professional expertise is treated as an aggravating factor because the CRA takes the position that your industry knowledge gave you access to information that ordinary buyers do not possess, making your personal use narrative harder to sustain. The extent and nature of any pre-sale renovations, a property that undergoes a complete cosmetic renovation in the 3 months before listing, is consistent with a flip strategy, not a family home. The financing structure, short-term variable rate financing inconsistent with a long-term owner-occupant profile, is documented and analyzed. The timing of the purchase relative to the market cycle, buying at a known cyclical trough and selling at the peak with a pattern of multiple such transactions across different properties, is evidence of systematic profit-seeking behavior. When the CRA's intention analysis concludes that the taxpayer was primarily motivated by profit, the reassessment does not just deny the exemption. It reclassifies the entire gain as business income, applies interest from the original filing deadline of the year of the sale, and in cases where the agency finds that the taxpayer willfully miscategorized the income, imposes a gross negligence penalty equal to 50% of the understated tax on a gain of $400,000 reclassified as business income for a taxpayer in the top marginal bracket in Ontario. The combined tax, interest, and penalty exposure can exceed $240,000. That number does not care about your mortgage. It does not care about your renovation costs. It does not negotiate. It accrues daily. And here is the piece that closes the trap permanently. The CRA's LEADS program, the mechanism through which members of the public, including neighbors, tenants, former business partners, and disgruntled family members, can anonymously report suspected tax non-compliance, has seen its submission volume increase significantly over the past several years. These leads are cross-referenced against property disposition data. A single lead that provides a CRA intake officer with a former tenant's name, a property address, and a rental period. Date range is sufficient to open a review that can cascade into a full forensic audit of every property disposition the taxpayer has made in the previous 6 years. You cannot intimidate a CRA algorithm. You cannot negotiate with a jeopardy assessment. You cannot charm a forensic auditor. What you can do, what the only rational response to this enforcement environment demands, is treat your documentation obligations with the same absolute precision that the institution pursuing you applies to its algorithmic review. If you claim the principal residence exemption on a property you have already sold, and you are now uncertain about whether your occupation proof is coherent, whether your renovation ACB documentation is complete, or whether your transaction pattern could be characterized as an adventure in the nature of trade, you are not in a comfortable position. You are in a position where the statute of limitations is running, and the CRA's systems may already be processing data points associated with your file. The rational action is to seek advice from a tax professional with specific experience in CRA audit defense. Not a general accountant, not a realtor, not a mortgage broker. A tax lawyer or a CPA who has represented clients through principal residence exemption disputes specifically, because the evidentiary and procedural dynamics of those disputes are distinct from standard income tax audits. Voluntary disclosure is an option that remains available to taxpayers who have not yet been formally notified of an audit, and it can significantly reduce the penalty exposure even when the underlying tax liability is substantial. The system that was built to reward homeowners for building equity in their primary residence has been systematically weaponized against everyone who treated that system as a loophole. The data infrastructure that CRA has assembled over the past decade makes the old strategies, cash rent, informal tenancies, abbreviated holding periods, undocumented renovations, not just risky, but mathematically certain to fail given sufficient time and sufficient appreciation in the underlying asset to make the audit cost-effective for the agency. This is not a prediction. This is already happening. Reassessment notices are landing in mailboxes across the Greater Toronto Area, the Lower Mainland, and the suburban corridors of every major Canadian market, where appreciation was most aggressive between 2016 and 2022. The taxpayers receiving those notices are not criminals in the conventional sense. Most of them genuinely believed, that what they were doing was acceptable. That belief is not a legal defense. The Income Tax Act does not have a provision for good intentions. One final thought before you decide what you want to investigate next. The 3 proof categories we broke down today, occupation documentation, renovation, ACB receipts, and intention evidence, are not independent. The CRA's audit process evaluates them simultaneously, and a weakness in any one category creates pressure on the others. A thin occupation record prompts the auditor to look harder at the renovation history. An inconsistent renovation receipt narrative prompts a deeper dive into the intention indicators, and once the intention analysis begins, the entire transaction history across every property you have ever owned becomes relevant. The audit does not stay contained, it metastasizes. What comes next is your call. Two directions we can go from here. Type A in the comments if you want us to investigate how the CRA's LEADS program specifically targets rental property owners. The exact mechanics of how a single anonymous tip becomes a multi-year forensic audit. Type B if you want the complete breakdown of how deficiency judgments survive bankruptcy and follow a taxpayer for decades after they thought they had escaped. Your vote determines the next investigation. Canada Property Watch. The numbers do not lie, the documents do not disappear. And the clock is already running.